Technology stocks, which outperformed the broader market through most of 2017, now appear to be leading the market into a correction. It's not just a case of seasonality or technical exhaustion, though. It's also a matter of expectations and changes in fundamentals. Let's start off here with the NASDAQ 100 versus the S&P 500. The green and red line here, the candles, are showing the dramatic rally in the NASDAQ 100 through most of this year. The solid red line of the S&P 500 shows the broader market and how much the NASDAQ has outperformed the broader market for much of this year. This was a smaller gap through the winter that really blew out open through the spring and especially through the summer. One of the things we look at when we're watching markets and the sustainability of rallies is how much of a difference is there between a market that's just driven by a few stocks and a broader advance. And something we see here in this is that the NASDAQ 100, especially the later stage of the rally, was driven by about 5 stocks, what they called the FAANG stocks: Facebook, Apple, Amazon, Netflix, Google. And when you get down to 5 stocks, at one point in the Dow, the whole thing was being driven by one stock when Boeing was going up. So that kind of breadth is usually indicative of a market that's exhausted and ready for a correction. Well, what are we starting to see here? We're actually starting to see the NASDAQ break down, a bit of a double top here in and around, and a failure at the 6,000 round number. We're now seeing the NASDAQ actually start to roll over. Initial support down here is about 57.70. Now, though, what's most important about this also here is take a look at this. The RSI has broken under 50, also signaling downward momentum. But what's most important about this is that the generals of the tech sector that led the advance are now the ones who are leading the retreat. Let's start here with Apple. As an example here, we can see Apple, hugely spectacular performance. You could almost make a case for a head and shoulders top here, but regardless, you had this huge negative divergence telling us upward momentum was slowing. Look at this. We broke the 50-day moving average, and it's continued to trend downward. RSI is showing Apple continues to accelerate to the downside. What's the problem with Apple and a lot of these tech stocks? When they had these massive rallies, built in huge expectations for earnings growth. What are we seeing with Apple, and why is it correcting? Earnings growth may not be as great as what the street was expecting. The apparently pre-sales for the iPhone 8 are going terrible. Nobody wants to line up for a slightly incrementally better product that's not even the cool one anymore, because that's the iPhone 10. And now there's been news out today that Apple's telling iPhone 10 component suppliers to hold back on some of their shipments, because it's suggesting that perhaps the demand for that one might not be as strong as had been hoped either. So Apple is starting to struggle fundamentally, and we're seeing it in the stock. Sitting on 150, next support down here, this 23%, actually, let's fix that. So it's sitting here on 150. It's completed a 23% retracement of its previous uptrend. The next support cluster here about 132.60, 142.60, and this is a 38% retracement, and the 200-day moving average 142.60 it could be a key technical level for Apple. Moving on here, we're starting to see more of them break down. Apple broke last week, now we're seeing more. Look at this. Here's Google Alphabet breaking an uptrend line. Now if we move over and take a look at Facebook, look at this one. Broke the 50-day moving average. Clear breakdown as well in Facebook underway. Now we look here at Amazon. Look at this one. It had already broken back in July. Big downward gap here. It's been muddling along here between 935 and 1,000. Could not retake 1,000, and it seems to be accelerating to the downside. And look at this on the RSI. Momentum accelerating to the downside. If that one breaks there at about 940, next supports the 200-day moving average, about $910 a share. And even Netflix here, if we look at this one, here's another example, right? Big double top. Look at that one. July, September, and a big breakdown today. And you had a negative RSI, lower high in the RSI, slowing upward momentum. You're back at 50. If this breaks, could be a signal of a downturn. You're sitting on 180. Resistance is 190. Next support around 171, and then around 160 based on this 23 and 38 Fibonacci retracement. What's important with Netflix is that there's a lot more talk that they're going to have a lot more competition, that the content creators, the big networks and the big studios have seen how much money Netflix is making, and they're starting to respond, and they're saying, well, if they can do it, we'll launch our own streaming services, and we won't pay Netflix anymore. So Disney has pulled out. There's been reports going around today that Fox might do something and bring more of their content back in-house as well. So this whole streaming model could start to fall apart, where people may end up having to pay to buy content from half a dozen studios rather than an aggregator like Netflix. And this is not unusual. This is the norm in economics when they talk about the short term and the long term. Someone gains a shorter term advantage. What is the longer term? The longer term is when the competitors have time to adapt. And in this case, that's what we're starting to see play out over the next couple of years, and we're already starting to see it show up in Netflix stocks. So a lot of the high expectations about tech stocks that we saw through the spring and the summer are starting to turn into disappointments. We're seeing sentiment turn against the technology sector, and we're seeing this group starting to lead the broad market downward.